Hi, good morning, Miss Chan. I'm Xiang Kang, and we are from Group 2. And today we'll be presenting about the insurance policy of Smart Protect Legacy Max, which is proposed by the Great Eastern Life Assurance. So here is the name list of our group member of 5. And the assignment outline basically is about the introduction of the insurance policy, assumption and formula to be applied during the assignment, result and discussion that we obtain from the calculation, and last, the conclusion, which is the annual gross premium. So Chun Yee and I will be presenting the introduction part. And the main purpose of this assignment is to propose the annual gross premium for a whole life insurance policy where death is the only decrement to be considered by us during the pricing calculation. What is Smart Protect Legacy Max? It's a whole life insurance which provides death benefit and its coverage age is up to 100 years old. And now we'll talk about the feature of the age of insurance policy. The minimum entry age of this policy is as low as 30 days at 10 age, which means that it's the first 30 days of a newborn life, while the maximum entry age is as high as 70 years next birthday, which indicates that it's until the 70th birthday of the insured. For the expiry age, it will be the same as the coverage age that I mentioned just now, which is 100 years old, and if one wants to purchase the policy individually, his or her age interval must be in between 18 to 70 years old. So there are 4 main coverage in this insurance policy, which is death, accidental death, public conveyance death, and total and permanent disability, which is also known as TPD. Let's look at this table describing the coverage period and amount to be covered for the insured. First, for the condition of death, the coverage period is up to 100 years old, while accidental death, public conveyance death, and TBD can only provide up to 70 years old. And for the amount to be covered, death, accidental death, and TBD provide 100% of sum assured, while public conveyance death can provide up to 200% of sum assured, and with optional benefit to be provided. Okay, so now I will pass to Chun Yee to further explain the additional benefit of this insurance policy.
I'm Chun Yee. Now I will proceed with the additional benefits. For additional benefits, an insurer will get an additional sum assured of 1% of the basic sum assured upon every completed policy year, and it will up to 30%. Not only that, this product lets the insurer to tailor their protection and investment level to suit their own needs and goals. The insurer can even increase the resources when he leaves the family with the option of boosting the investment value of the policy by single premium top-up, subject to a minimum of 1,000 ringgit Malaysia per top-up. Furthermore, a boosted reward of 12% of the basic sum assured will be credited into the total investment value account on the policy anniversary of attained age 70 years next birthday or at the end of the 30th policy year. Last, this insurance comes with a no-lapse guarantee for the first 6 years. This ensures that the policy will continue to remain in force even if the total investment value becomes zero. This just be provided that the insurers pay the premium consistently and no withdrawal with the first 6 policy years. Now, let's have a look for the overview of the benefits. Consider a 35-year-old man purchased the policy with a basic sum assured of 500,000 ringgit Malaysia. He will have insurance protection against death, accidental death, and TBD. His coverage also will increase by additional 1% each year, and he will get a booster reward of 12% of the basic sum assured amounting to 60,000 ringgit Malaysia credited to his total investment value. If nothing unexpected happens, he will receive the total investment value when his policy matures. Next, we move on to our assumptions. We have 6 assumptions used in the assignment. First, we fix our sum assured to be 500,000 ringgit Malaysia and assume that there is no surrenders during the policy life. The interest rate is also fixed at 6% per annum. Moving on, the mortality rate for both female and male follow the mortality table given in the Excel file. To calculate our annual gross premium, we need to assume the expected loss is equivalent to 0, and the expenses will be 15% for the first year and 10% for every renewal year. Now, Ling will take over my part to continue with the formulas.
My name is Ling. I'll be presenting formula and result. This assignment, we use 4 formulas to calculate. First, we use discrete whole life insurance to calculate expected present value of future benefit. As you can see in the timeline, a person die within year X and X plus 1 will receive benefit at the end of the year, and we discount the benefit back to the current time with the discounting factor and probability of death. For a person who survived within year X and X plus 1 and die within year X plus 1 and X plus 2, we will discount back the benefit to the current time with the discounting factor and the probability of death to get the present value. Similarly, this formula will be applied for the following year. In general, we sum them up to get the actual present value of whole life insurance. Next, we use whole life annuity to calculate expected present value of future premium. For a person die within X and X plus 1 will pay premium at the beginning of the year. For a person who survived for first year and die at the following year, we have to discount back the premium with the discounting factor and probability of survival. The same goes to the following year. We sum them up to get the formula for the whole life annuity due. So, for expected present value of future expenses, as you can see in the timeline, we times the amount of expenses in each particular year with expected present value of future premium, and we also sum them up to get the formula. Lastly, for equivalence principle, is equals to expected present value of future benefit plus expected present value of future expenses minus expected present value of future premium. I will proceed the results. We will refer the calculation to our Excel sheet. As you can see, this is our mortality table for male and female. Next, we choose male to be our gender, and we have our entry age to be 20. We fix our sum assured to be 500,000. And now we come to our premium calculations. For expected present value of benefit, we have sum assured times with mortality rate with discounting factor. For expected present value of premium, we discount back the discounting factor with KPX. For expected present value of expenses, we times expenses with a discounting factor and KPX. So all the summations are shown here. So the annual gross premium we get based on equivalence principle on these 3 values is 1893.12. So when we have the age to be 40, this is the annual gross premium we will get.
My name is Wenli and I'll be talking about the discussions. Mortality rate is defined as the frequency of death. It also means the probability of one dying. The mortality rate starts to increase when age of one increases because he is exposed to more risk. As you can see, the mortality rate increases to the age of 21, but it starts to decrease after that. However, the mortality rate increases after the age of 34 because we assume that one will have a higher chance of dying as he is aging. Moving on, the KPX is the probability that a person aged exactly X lives for another K years. As mentioned previously, one is exposed to more risk as age increases. Conversely, the probability of one surviving will decrease when age increases. Next, we will look at this table. As you can see, the expected present value of benefits does not have a specific trend when the age increases. It goes up and down based on the mortality rates. However, the expected present value of premiums and expenses decreases as age increases. Notice that for the expected present value of expenses, we use 15% of the annual gross premium as our expenses for the first year and 10% for the subsequent years. This is because commissions are usually higher than the renewal commissions. Many other expenses occur only in the first year too, such as underwriting and policy issue. As mentioned earlier, we have used the equivalence principle to calculate our annual gross premium. From the equivalence principle, we assume that the expected loss of an insurance policy to the issuer be equal to 0. However, this is not true in the real world because insurance companies tend to charge higher premiums at their insured in order to earn profit out of it. This explains why the annual gross premium calculated in our Excel sheet has a lower price compared to the actual premium charged by the insurance company. Lastly, we compare the mortality rates between males and females. At the same age, females have a lower mortality rate compared to males. Males tend to have more fatal jobs such as firefighters, logging, and construction site workers, whereas a large number of females work as educators, childcare providers, veterinarians, and so on. One more interesting fact that females live longer is because of their biological factor. Females have 2 X chromosomes while males have 1 X chromosome and 1 Y chromosome. Females have 2 variants of each gene on the X chromosome. The gene variants act as backups for each other, so if a gene on the X chromosome is not functional, the gene copy on the other chromosome can compensate for this. In contrast, only 1 copy of most genes on the X chromosome is present in males, and no backup is available if the X chromosome is mutated. In addition, we have prepared a table which consists of the annual gross premium for both males and females at different entry age. As you can see from this graph, it is obvious that females have a lower annual gross premium compared to males. For example, at an entry age of 30, female insureds only need to pay 2,080 and 50 cents, while male insureds need to pay 3,020 and 80 cents. While at the entry age of 50, female insureds only need to pay 6,633 and 14 cents, while male insureds need to pay 9,617 and 27 cents. Now we will proceed to the conclusion.
I'm Wen Kai. I will talk about the conclusion. All in all, Smart Protect Legacy Max is a whole life insurance product proposed by the Great Eastern Life Assurance Berhad, which provides death benefit. The insurance policy can cover up to 100 years old. Furthermore, the basic sum assured of the insurance policy that will be compensated to insured is 500,000 ringgit. Moreover, insured will be provided a protection against death, which is death, accidental death, public convenience death, and TBD. This insurance policy takes genders, ages, mortality rate, type of coverage, amount of coverage, and insurance history into consideration. However, there are some limitations on calculation the gross premium of an insurance policy. In real life, policyholders will not pay the premium at the end of every year. They will settle the insurance premium in a monthly basis. Monthly payment will be the most common mode of payment due to the fact that employees receive their salary monthly and it's convenient to have payment made within the same frequency as income is received. One important feature for any life insurance policy is that premiums are payable in advance, with the first premium payable when the policy is purchased. Regular premium for a policy on a single life increases upon the death of the policyholders. Also, insurance companies tend to charge higher premium at their insured in order to earn profit. This explains why the annual gross premium calculated in our Excel sheet has a lower price compared to the actual premium charges by the insurance company. Furthermore, we can assume that the Great Eastern might also use a higher mortality rate, which causes the actual premium to be higher than the value that we have calculated. For the future improvement, the insurance company can increase the entry age to let more people can buy the insurance. Next, the insurance policy can cover for some medical diseases like cancer, first heart attack, stroke, and some more. Lastly, insurance company can lower the premium rate based on the financial condition of insured. Last but not least, Smart Protect Legacy Max is a full-time coverage with this premium linked protection plan that offers long-term coverage, benefit, and saving all at once. It helps ensure that you and your loved one are always prepared with this comprehensive plan. Thank you for your attention, Miss. This is all for our presentation.